Picture Stockholm on a winter morning in 2022 beneath its first snow. 151% of annual income. That is what Swedish households carried in mortgage debt. Most developed economies would classify this level as reckless, but this isn't the setup for a sudden crash, it's stability hiding mechanical pressure underneath. Every 90 days your mortgage rate resets completely. Not annually like other developed countries, not every 5 years like Canada. This quarterly reset happens 4 times yearly. Here's the core thesis. Quarterly resets create slow squeeze instead of sudden financial crash. Why did an entire nation structure mortgages around 90-day resets when other countries locked in fixed rates for years or decades? 74% of Swedish mortgages operated at variable rates tied to 3-month resets because they were substantially cheaper than fixed alternatives. 86% of household debt lived inside mortgages, mostly resetting quarterly. Your home became Sweden's primary wealth accumulation engine, driving consumer confidence through 2 decades of stability. Banks said yes to bigger borrowing, households said yes to bigger mortgages. But leverage built through reasonable choices looks safe until it stops looking safe. Between 2000 and 2022, Swedish house prices nearly doubled in absolute value. That transformation happened because you felt richer and more secure about your future. You felt wealthier, spent freely, borrowed confidently. This is what economists call the wealth effect. 10% of house price declines pulls household consumption down by 2% of GDP. Not because fundamentals changed dramatically, because your psychology inverted catastrophically. What changed when your house lost value? Not your job, not your income. Your behavior inverted completely. Your expectations collapsed entirely. Your willingness to spend evaporated. Sweden's households were about to experience this exact inversion. February 2022 brought inflation surging across Europe, forcing central banks into deliberate action. 9 rate hikes in 12 months meant nearly 1 per month constantly. Sweden's central bank moved through 2023, rising from near zero to 3.75% by mid-year. 2% inflation in 2021 became 4% by 2023. Inflation doubled in 2 years. Your payment on a 3 million krona mortgage jumped 250,000 krona every single year. 14% of disposable income simply vanishing into interest payments monthly. Most households could technically pay it. What they couldn't do was keep spending like before, setting demand destruction in motion. Housing prices don't defy gravity forever. They simply defer it until deferral becomes impossible. 16% down from peaks. That is the aggregate Swedish decline across markets. Greater Stockholm fell 6.3%. Malmö fell 8.7% across the region. To a household already compressed by higher rates, this decline was devastating. Your asset base shrinks 16%, while mortgage debt stays fixed completely. Your borrowing power evaporates. The psychological shift inverts entirely. You don't feel rich anymore, you feel exposed. Not a crash by conventional definitions. This exposure changes everything downstream. By 2024, the squeeze was visible everywhere across spending patterns. 8 of 10 Swedish consumers reported elevated prices for groceries and utilities. 27% said household income dropped significantly. 28% cut savings entirely to maintain basic cash flow. Swedes stopped buying non-essentials completely. Why did this happen? Because your mortgage payment rose 14% of disposable income. Because your house is worth 16% less. Because your real wages are essentially flat despite nominal increases. You make different choices. 39% shifted spending toward groceries and basics, things you cannot skip or postpone. This mechanism compressed discretionary behavior downstream. Disposable income grows nominally through the year, but growth is slow and distribution matters enormously. Most households in 2024 experienced essentially flat real disposable income despite wage growth. Inflation consumed every gain and took seconds from future spending power. Your debt burden pressed relentlessly downward on whatever room remained. 156%. That is the household debt-to-income ratio in 2023. By 2024, it fell to 151%. That sounds like deleveraging progress. Not really. The ratio fell because nominal income rose faster than debt accumulated, not because you paid down mortgages aggressively. Credit growth collapsed to near zero. Not deleveraging. It's demand destruction wearing recovery's mask. 86% of GDP, that is, household debt concentrated entirely in mortgages. This matters because policy rate changes don't phase in gradually across quarters. They arrive in 90-day increments, 4 times per year. 100 basis points of rate movement swings household disposable income by roughly 1% of GDP. That is real purchasing power shifting 1% of your entire economy 4 times yearly. Every quarter, roughly 150 billion kroner of household disposable income shifts between pockets and banks. When that lever moves, consumption moves next. When consumption moves, employment moves. When employment moves, the whole system tilts. By 2024, the squeeze produced measurable results across the real economy. 6% pre-pandemic credit growth fell to 2% projected for 2024. Not a pause, a structural shift in how millions of households behave. When households stop borrowing, GDP follows like shadow follows light. 3% GDP growth expectations fell to 1.2% by 2024. Not a crash yet, a grind. Long, slow weakening of momentum, compounding quarter after quarter. You feel this in labour markets first, where hiring slows before anyone admits recession is possible. The Riksbank faced a problem with no clean solution at all. Cut rates and ease your pressure, or hold rates while your distress deepens into unemployment. That is the bind. Early cuts when inflation lingers carry hidden costs downstream. They unanchor expectations. They risk price pressures returning later. Through 2024, the bank moved cautiously with gradual cuts. But households aren't patient when squeezed. You'd already adjusted downward. You're saving more. You're consuming less. Policy relief felt too slow. One central bank can't solve 2 incompatible problems: inflation stability and your household squeeze. Not really. One interest rate can't solve both. The medication fixing inflation potentially aggravates household distress. Not all Swedes squeeze equally across income levels. If you're wealthy with fixed-rate mortgages and substantial capital buffers, you adjust with relative ease. If you're younger, a recent buyer on variable rates, you feel it acutely. When pain distributes unevenly, inequality widens visibly. Social consumption patterns split. Luxury retail holds steady, discount retail booms. The middle class contracts visibly. This isn't just economic fact, it's political economy determining electoral outcomes. When half your country feels squeezed and the other half doesn't, patience erodes. Social cohesion frays. Institutions face pressure. The Riksbank faces pressure to cut faster. Government faces pressure to intervene. Opposition pressure builds naturally. When pressure accumulates, policy lurches prematurely. The housing market tells the squeeze story in real time through transaction volumes. 2023 was the worst year since the 1990s for transaction volumes. By mid-2024, volumes recovered somewhat, but remained 30% below pre-crisis norms. What emerges when prices stop rising? Forced sellers meeting reluctant buyers. You're forced to sell because of relocation, divorce, employment changes. They're reluctant because they couldn't justify prices at these rates. This is a market without conviction, where psychology shifted from appreciation building to damage control. Your mortgage holders knew selling wasn't an option, refinancing impossible. They were locked in, they stayed, but they didn't spend. That non-spending is how the squeeze propagates. Sweden isn't alone in carrying high household debt across developed nations. Denmark has similar structures. Canada's mortgage market carries comparable burdens. But Sweden's fragility is unique. 74% of mortgages operate at variable rates with 3-month resets, among the highest in the developed world. Not debt amount, it's reset frequency. Other countries have longer fixations, 5 years, 7 years, 10 years. They pay slightly higher rates for that predictability. Swedish borrowers optimized for cheapest rates and flexibility to refinance. You got cheap money and quarterly resets every 90 days. Now you're learning the cost, the bill arriving quarterly, the squeeze compounding. This is where the story settles. Not crash, but grind. Slow demand compression, modest GDP weakness, unemployment ticking upward gradually, investment pausing indefinitely, labour market feeling pressure first, as always, wage growth moderating because employers expect slower demand ahead. You become more cautious about job switching. Consumer confidence, once broken, rebuilds very slowly over years, not months. The Riksbank cut rates through 2024, but economies respond with a lag. By the time relief arrived, you'd adjusted expectations downward. 2 to 4 years minimum, that is what reverses expectational shifts like this. That's the true recovery horizon. One rate cut cycle isn't enough. You're looking at a long grind where the squeeze compounds continuously. Return to Stockholm now, winter 2026. The city looks unchanged. Buildings stand, streets move, people walk past banks and pension offices. But inside those balance sheets, inside mortgage contracts, inside your household ledgers, the machinery grinds slower. 151% of income in debt, 86% of GDP in household mortgages, most resetting every 90 days. This quarter, next quarter, every quarter forward. Somewhere right now you're opening an envelope from your bank, learning whether the rate fell or rose slightly. The payment adjusts. It always does. That certainty was once a feature, cheap money flowing perpetually. Now it's vulnerability. Quarterly reminder of exposure. Every 3 months the system recalibrates. Every quarter pressure finds its level. The crash wasn't the risk you feared. The slow squeeze is. And every 90 days it will begin again.